Right, hello everybody. This is now week 11 and chapter 11. I do want to remind everybody there's an upcoming event, the Arts Outreach Cultural Diversity Conference on April 21st. This is 2023 for future reference. So if you're watching a recording of this in a future semester, please disregard. But this event is coming up and all students are welcome to attend. I did offer to give 1 extra credit point to students who attend. It is going to be at our King City location from 1 to 4 on the 21st. So that's a week from Friday. If you are interested in going, you can open up the flyer and you'll see a QR code. You'll also see a URL. You could use those to RSVP for the conference, and I will look forward to seeing you there. It should be, I think, fun and interesting for everybody who attends. Even if you're not an artist, it's for everybody. It's about how we can increase opportunities for artists in our communities. And it does relate to business and to accounting in some way. So I hope you will consider attending. Okay, that's the only announcement I have for us. What else did I have here? Oh, I did want to point out chapter 11 does have some accounting stuff videos. So you'll want to scroll down to chapter 11 and you see 5 different videos related to depreciation. All of them are relevant for us, except this one that says sum of the year's digits. I'm not actually even familiar with that depreciation method. We don't use it in this course, and I don't even think it's mentioned in the textbook. But the other 4 are useful for you. So if you get a little confused about depreciation, what it is and how it works, you might want to watch this basic interview that has journal entries included. You also have specific videos about specific methods like the double declining method, which is the most complex of the 3 that we're going to learn, the straight line method, and units of production. Okay. Then we're not going to have any other relevant accounting stuff videos until chapter 16. Other than that, we are ready to get into our course material. So let me go ahead and open up the exercise set here. We have only 12 exercises, and some are pretty easy. Some are a little more involved. We do have some problems we'll go through as well. Let's see, 1, 2, 3, 6 problems we'll go through together. I don't think we'll need the full 2 hours today, but let's just go ahead and see how it goes. So starting with exercise 1. We have a list of different assets from a trial balance, and we have to figure out what is the balance of the PPE, or property, plant, and equipment. So those would be the long-term assets that are used in the production of the product or in the overall generation of revenue. So they would not include cash because cash is a short-term asset, and this chapter is about long-term assets. So we will not include cash as part of PPE. Equipment, though, is the E in PPE, property, plant, and equipment. So yes, that would be part of our PPE. Accounts receivable, again, is a current asset. It's not long-term, and so it's also not PPE. A copyright is a long-term asset, but it's not considered PPE. Now, it is intellectual property, so it is property in a sense, but PPE, again, refers to buildings, land, vehicles and equipment. It would not include copyrights. Inventory is a current asset. Patents are intangible assets or intellectual property. So again, they are long-term assets, but not PPE. And a building would be property, so that is PPE. So really the only two things here that qualify as property, plant, or equipment are the equipment and building, and together they have a total value of $160,000, and so that is our answer. Again, the chapters on long-term assets, PPE is one type of long-term asset. Let's see, intangible assets are another type of long-term asset. Those would include patents and copyrights, but they would also include trademarks and something we'll get to a little bit later called goodwill. What else would be a long-term asset? We have long-term investments. So if a company makes an investment that they expect to keep for at least a year, that would be also a long-term asset, although it's not PPE. And we have other long-term assets. So sometimes you'll see on a balance sheet a category of other long-term assets. As we go through this chapter, it can be a little tricky at times. Keep in mind, we've got these different classifications of long-term assets. They almost all get capitalized. And what that means is that we can't count the expense of the asset all at one time. We typically have to spread it over the life of the asset, or at least the expected life of the asset. So we take some of that expense each year until we've depreciated the entire cost of the asset, or what's called the depreciable base. We'll get to that a little bit later as well. One exception would be land. Land does not get depreciated. And when we talk about intangible assets, those get amortized. It's a similar process to depreciation, but it's called amortization. And if we're talking about natural resources that a company might own, those get depleted. And again, it's a similar process, but a different term. Okay, so more on that later. We've done exercise 1. Let's move on to number 2. So this company has these transactions. We have to figure out which of these would be capitalized, meaning we'll take the cost of it and spread it out over a period of time, and which of them are expensed, meaning we just count the expense at the time that it occurs. Okay, the first one, we buy a machine for $500,000. Well, that is a long-term asset, and we are going to have to spread out the cost of that asset over multiple years using depreciation. So I'm going to go ahead and highlight that, or actually I'll make it bold. And that will signify that that's an asset we need to capitalize. The next on the list is an ordinary repair. So we had to make some just normal repairs to an asset that we would consider an expense. So I'm going to underline that. Then we buy a patent. A patent does get capitalized. Again, we call it amortization, but it is a form of capitalizing that asset over multiple years. And so I'm going to go ahead and make that bold. Next, we pay $200,000 for an addition to a building. Well, buildings are property, so an addition to a building is a property as well, or it increases the value of the property. And so that is also something we have to capitalize. We can't take that expense all at one time. We have to spread it over multiple years. So that will be capitalized. Salaries are expenses. They happen all the time, and we just go ahead and count them as an expense. when they occur. Routine maintenance, again, just like an ordinary repair, is treated as an expense. However, an extraordinary repair, if we are making repairs that increase the value of the asset or extend its lifespan, then we can go ahead and capitalize those costs. Okay, so let's add up the capitalized costs. We have the machine for 500,000, the patent, the addition to the building, and the extraordinary repairs. And that's $755,000. Okay, now let's add up the expenses. We had 500 plus 60,000 plus 250, so $60,750. Okay, so those are the answers for number 2. Let's go on to number 3. Here, a company buys a delivery truck for $15,000. The truck has a salvage value of $3,000. So what that means is the company is expecting that in the future, they're going to sell the truck for $3,000, and they only depreciate the difference between the cost and the salvage value. So basically, the idea is you're trying to figure out what are the actual costs that you've incurred, you know, once you subtract out money you're going to get in the future from selling the asset, and that's the amount you'll depreciate. It's called your depreciable base. If you're using straight line depreciation, which is one of the 3 methods of depreciation that we cover in this chapter, what you do is you take the depreciable base and you divide it by the number of years you expect to use the asset. So again, in this case, it was a $15,000 truck. We subtract the $3,000 salvage value. So we have a $12,000 depreciable base. We divide that by the number of years we expect to use the truck, and we'll take $1,500 of depreciation expense each year for 8 years. At that point, after 8 years, we will have taken $12,000 of depreciation. And if we sell the truck for $3,000, perfect. We took the full depreciation expense. If we sell the truck for more or less, or if we don't sell the truck, it's okay. We can always adjust our depreciation later. But at least for now, based on our estimates, we know how much depreciation expense to claim every year. Now, let's say that the company decided instead of the straight line depreciation, they wanted to use the units of production method. Well, what you do in this case is you start out the same. You take the original cost minus the salvage value to get your depreciable base. Again, that was $15,000 minus the salvage value. There we go. So we have a depreciable base of $12,000. But in this case, instead of dividing it by the number of years we plan to use the asset instead, we are going to divide it by the 120,000 miles we expect to drive that truck over the 8 years. So if we divide by the 120,000 miles, we get a rate of 10 cents per mile. Now we just multiply that by the actual number of miles we drive every year, and that's how we get our depreciation amount. So in the first year, they expect to use the truck for 23,000 miles. So we multiply our 10 cents times 23,000, and we would take $2,300 of depreciation expense in the first year. Oops, sorry, I put that in the wrong place. Thought I clicked in the right place, and I guess I didn't. Okay. This units of production method is useful if your production tends to vary significantly, because in years when you have a lot of orders and you're producing a lot, you're going to get a larger depreciation expense. In years where you have fewer orders from your customers and you're not producing as much, you'll have a lower depreciation expense. So in the years where you have more revenue, you'll have more expenses to kind of even out your profits and reduce your tax liability. In years where you have lower revenues, you'll have lower expenses. So again, it helps to even out your profits, so you don't have these huge swings. All right, so we've completed exercise 4. Let's move on. When we are calculating our depreciation, we start with the cost of the asset. But what I haven't told you is that that includes shipping costs. It includes taxes. It includes any other costs associated with getting that asset in place and getting it operational. So in this case, for example, some equipment has been purchased for $25,000. However, the company got a 5% discount on that. They had to pay shipping. They had to pay installation fees. And those increase the acquisition cost. The company also has a $200 annual maintenance cost, but that's not part of the acquisition of the asset. It's an ongoing maintenance cost. So we're not going to include that in the acquisition cost. So to determine the acquisition cost, let's go ahead and start with our $25,000. Then remember, we got a 5% discount. So the easy way to calculate that is you go minus 5% equals. So that subtracted 5% of the cost and brought it down to $23,750. Then we have to add those $1,000 of shipping costs and the $2,000 of installation costs, and we get a total of $26,750. So that is our acquisition cost. Okay. And moving on to number 6. Here we have a patent. So again, a patent is an intellectual, well, it's intellectual property, so it's an intangible asset. There are other intangible assets as well, but what we mean, well, okay, let me explain myself. We're going to see some other types of assets that are intangible in the sense that you can't touch them, but they're not what we consider intangible assets in this chapter. What we mean by intangible assets is patents, copyrights, trademarks, goodwill, which we'll come back to. The textbook mentions franchises, but we don't have to worry about that in the homework. Those are what we mean by intangible assets, okay? So basically think of it as intellectual property and goodwill as intangible assets. In this case, we have a patent that cost $21,000. Now they tell us here that the life of the patent is 20 years, which means that for 20 years, we can use that, we can sell that drug or whatever the patent's for. And if anybody else tries to sell our drug, we could sue them because they're violating our patent. After the end of that 20 years, our patent has expired and other people can make their own version of that drug and we can't do anything about it. Maybe we can come out with a revised version of the drug and have a new patent on that new version, but the old version would already be out of patent. So it cannot be protected in its original form. However, that's the legal life of the patent. For depreciation, what we care about is how many years the company plans to use the intangible asset. And here we see that they only plan to use it for 15 years. That's the amount we need in calculating how much to amortize this intangible asset. So what we're going to do is take the cost of the asset, $21,000, divide it by the 15 years we're planning to use it. Oops, there we go. And it comes out to $1,400 a year. So every year we'll take $1,400 of amortization expense until 15 years go by. At that point, we will have taken the entire $21,000 as an amortization expense, and we would stop amortizing. And what we would do is we would credit the patent. So the patent is an asset, and assets increase on the debit side, they decrease on the credit side. So by crediting the patent, we're reducing its value on our books each year by the amount of the depreciation. So after the 15 years, we would look in the patent account and we would see it now has a value of 0 because it's been fully amortized. Okay. If we were to sell the asset at anything above 0, that would be a gain. If we sold it for less than the value, that would be a loss. Obviously, we're not going to sell it for less than 0. But let's say the book value at a particular point in time was $10,000 for that patent. If we sold it for less than that, we're selling it at a loss. And we'll see how we journalize that a little bit later. Okay, so that's how we deal with intangible assets. Now with exercise 7, we're back to a physical asset, in this case, a 3D printer, and a very expensive 3D printer that cost $900,000. Well, a company that puts out that kind of money for that sort of equipment, they would probably want a pretty big tax break in the first year of paying for that product that they purchased. So they might use the double declining method of depreciation. This one's a little more complex than the other methods we saw, the straight line and the units of production methods. But it does allow us to take a bigger expense in the first year. To show you how it works, I'm actually going to create a table here. Let's make a 4x4 table. Okay, and we had year 1, 2, 3. In the first column, we're going to have the depreciation expense. In the second column, we'll have the accumulated depreciation. And in the third column, we will have the book value. Okay? Jeez, sorry. It's been a long day, apparently. Book value, okay. Now, I should also point out that the salvage value on this printer is $15,000. When we're using the double declining method, we don't factor in the salvage value until the final year. Okay, so let's do it like this. The original book value is the cost of the asset, which is $900,000. And the final book value is going to be the salvage value of $15,000. And we're going to depreciate everything in between. Okay, we don't depreciate the salvage value because that's how much we're expecting to get when we sell the printer in 3 years. So why depreciate it if that money is just coming back to us, right? We can't really count it as an expense if we got the money back. Okay, so then what we do in this double declining method is we use the number 2 for double divided by the number of years that we expect to use the asset. Okay, so in this case, I'm just going to write it right here. 2 for double divided by 3, because even though the printer can last 10 years, we're planning to sell it in 3. So 2 divided by 3. What we do with that is we multiply that by the book value. So in year 1, we started with a $900,000 cost, $900,000 book value of that printer on our books. We're going to multiply that by 2, divide by 3. Or you could say multiply by 2/3. Same concept. And that means in the first year, we get to take $600,000 of depreciation on that asset. That is a big depreciation expense, and it's really going to reduce our tax liability. Oops. Typo. So far, we've only taken that $600,000 of depreciation. So our accumulated depreciation is $600,000. So basically, this amount of depreciation expense, we are adding in this column. But we are going to subtract it from this column. So our original book value was $900,000. We took $600,000 of depreciation. So our new book value for the printer is the difference, $300,000. That's the amount that we're then going to multiply by 2 divided by 3 for year 2. And when we do that, 300,000 times 2/3, that comes out to $200,000. Okay, so that is the amount of depreciation expense we are going to take. I don't know what's up with my table here. Sorry about that. Oh my gosh. Trying to get these to line up. Good enough. Okay, looks like Jane has joined us. Hi, Jane.
Hello.
We are on exercise 7. And you'll be able to see the previous exercises once I post the recording. And what we're doing right now is the double declining method. So we're on year 2 of this exercise. And in year 2, we took our book value, multiplied by 2 for double, divided by 3 for the number of years that we expect to use the asset. And that means we get to take a $200,000 depreciation expense in year 2. We are going to add that in this column. And we are going to subtract the 200,000 in this column. So basically our book value has now gone down to $100,000 for the printer. When we're using the double declining method in the final year, we don't have to worry about the 2/3. All we're going to do is take the old book value and depreciate enough to get us to the final salvage value. So that would be $85,000. Okay, so that's the depreciation expense we take in year 3. Again, we're going to add that here to accumulated depreciation. So we've taken a total of $885,000 of depreciation, which makes sense because we started with a $900,000 asset. We took $885,000 of depreciation, which leaves us with a $15,000 book value based on the salvage value that we originally estimated. Okay, so those are the steps for the double declining method. We do have at least one more I don't remember if it's an exercise or problem that we'll go over like that. So we'll get to practice it again. And Jane, I know you came in on the middle of that one, but were there any questions that you had?
No, I'll just check it when I see the video again.
Sounds good. Okay. All right, so let's move on to exercise 8. This one is using the same data as exercise 7, but we're going to use the straight line method. So that'll be quick and easy because if you remember, we take the cost of the asset, which is 900,000, subtract the salvage value. That gives us our depreciable base. Divide that by the number of years we plan to use the asset, and that gets us our annual depreciation amount. So our answer for exercise 8 is a simple $295,000 per year. Okay, so that was not so bad. On number 9, we need to figure out an acquisition cost. So let's make a little more space here. Okay, number 9, we bought a $4.5 million boat. That boat had to be shipped to us. So we had to have the ship shipped. And we can include that cost in our acquisition cost. So that will become part of our calculation of our total acquisition cost, which means that it will get capitalized when we calculate the depreciation. Now, the yearly insurance cost is not part of the acquisition of the product, so that is not going to be part of our acquisition cost. And same thing with annual maintenance. However, we do have to factor in the 8% discount, okay? So if we start from the beginning here, we have a $4,500,000 purchase, but we got an 8% discount. So I'm going to go minus 8% equals, that takes 8% off of that 4.5 million. And then I need to add that $25,000 shipping costs. So the acquisition cost of this boat is $4,165,000. That is a debit to boat account. And because we paid cash, a credit to cash. Okay, so that's how we would journalize the acquisition. Then when we depreciate in the future, which basically you do at the end of every year, we would take that acquisition cost and use that to calculate how much depreciation. All right, so let's go ahead and move on here to number 10. Jane, just let me know if any questions come up. Here we have another intangible asset, a copyright. In this case, it says the copyright is expected to last 25 years, but the company's only going to use it for 15. So we will amortize this copyright over 15 years. The cost was $15,000. Well, this is pretty easy. We divide the cost of $15,000 by the 15 years we plan to use the asset. And that means every year we will take $1,000 of amortization expense. Now, with amortization, as we saw earlier, I believe, with the patent example, when we take the expense, we actually reduce the value of that asset. So we credit copyright. It's not the same with depreciation or with depletion of natural resources. In those cases, we have an accumulated depreciation or accumulated depletion account where we keep track of how much depreciation we've taken. But again, with intangible assets, we don't do that. We just subtract that amortization from the value of the asset until we get down to 0. All right, number 11. There's a patent with a 20-year legal life, but it only is going to be used for 7 years. The question is, what is the useful life over which the asset will be amortized? Well, 7 years, right? And the second one, there's a copyright with a 30-year life, but they're only going to use it for 10 years. Again, we would amortize over 10 years. So the answer to A was 10 years, and was 7 years. And the answer to B was 10 years. Okay, that was pretty easy. And this last one is fairly easy as well. This company buys a fork truck, which I think is another name for a forklift, and had an original useful life of 5 years, okay? So it had a 5-year useful life. Then after they depreciate the asset for 3 years, they make a major repair that extends the life by 4 years. What is the remaining useful life? Okay, so we started off with a 5-year life of the asset. 3 years go by, right? So now we're down to 2 years left. Then we extend the life by another 4 years. So 2 plus 4 gets us up to 6 years of remaining life for this truck, okay? So our answer here is 6 years, right? We started with 5, 3 years go by, so we have 2 years left. Extend that by another 4 years, that gives us 6 years. Okay, so those are all the exercises for this week, and let's go ahead and tackle these problems. All right, starting with problem number 5. Okay, this one is similar to the exercise that we did, one of the exercises we did, although it is a little different. In this one, instead of figuring out what needs to be capitalized versus expensed, we're figuring out what is the impact on this company's PPE and what is the impact on their expenses. So anything that is going to be considered an increase to PPE, I'm going to bold. If it's a decrease to PPE, I will also bold it. And anything that's going to increase expenses, I'm going to underline. So a machine is PPE, right? Property, plant, and equipment. So that would, by buying that $500,000 machine, that's going to increase our overall PPE. Paying $500 for a repair, if it's just an ordinary repair, that is considered an expense. Now, a patent is something we would capitalize, but it's not considered PPE. So for this problem, we are not going to consider that. We will go on to this $200,000 addition to a building. Okay, buildings are property, right? They do fall into the category of property, plant, and equipment. So if we're adding on to a building, that is also property, plant, and equipment. So I'm going to go ahead and bold that one. Salaries are expenses, so that will be underlined. Routine maintenance is an expense. Major repairs extend the life of an asset or increase its value. So that we are going to go ahead and consider part of the value of our PPE, okay? So it will increase the asset value. Now the last line here, depreciation expense. Well, that obviously is an expense, so it's going to get underlined. But it also reduces the value of our PPE. Remember that when we take depreciation and we journalize it, we debit depreciation expense, we credit accumulated depreciation. And that is a contra asset account that reduces the net value of our assets. So in other words, this depreciation expense is an expense, but it's also reducing the value of our assets. So we have to factor that into our PPE calculation. So now we can add things up. We had the $500,000 machine plus the $200,000 building addition plus the $10,000 repairs minus the $25,000 of depreciation, which decreases the asset value. And that brings us to a net increase on PPE of $685,000. Okay. Then the expenses are the $500 ordinary repair, the $60,000 salaries, the $250 routine equipment maintenance, and the $25,000 of depreciation expense. So our expenses go up by $85,750. Those are our answers here for problem 5. All right, next we'll do problem 6. This one is actually pretty easy. It's depletion. And again, depletion relates to natural resources. So if you have a forest, for example, and you're cutting down the trees in the forest, you're depleting that natural resource. So this is how we account for it. We take the cost of the natural resource. In this case, it's a mine that the rights to the mine cost $23 million. Well, I didn't say that right. $23,100,000. And we divide that cost by how much we expect it to produce, which is 1 million tons of ore. So that will give us a rate per ton of ore. So we take the 23.1 million divided by 1 million tons, and we get a rate of $23.10 per ton of ore. Now, this is the amount of production for each of the first 5 years. So I'm going to go ahead and put this rate we just calculated here for each year. Okay, there we go. All right, so $23.10 times 50,000 tons is $1,155,000 of the, sorry, not sure how I did that. Clicked on the wrong thing somehow. Okay, let's try that again. $1,155,000 is the total depletion for year 1 by taking the rate of 2310 and multiplying that by the 50,000 tons. Okay. Then we'll do the same for year 2, 2310 times 90,000 tons, 2,079,000. Year 3, we've got 2310 times 100,000. Oh, that's easy. 2,310,000. In year 4, 2310 times 110,000. 2,541,000. And in year 5, 2310 times 130,000 is 3,003,000. Okay, so that's how we do depletion. Pretty easy. There's no salvage value to worry about. It's basically like doing the units of production method, just without a salvage value. Okay. And so that's it for number 6. I think that's the only depletion problem there is. I think next we will do problem 8. Oh, I take that back. Number 7 is a depletion problem, but I think you can handle that. Okay, so number 8 is another double declining method problem. So again, I think it's easiest if we use a table to solve this sort of problem. So I'm going to go ahead and put a table in here, another 4x4 table. And I'm going to put depreciation expense here, put book value over here. This is going to be accumulated depreciation. And then we've got year 1, whatever, year 2, year 3. Okay. So let's solve it this way. The company bought a $450,000 printer. It's expected to last 10 years, but they're planning to replace it in 3 years. So we will depreciate it over 3 years. The salvage value that they expect to be able to sell the printer at in 3 years is $30,000. Okay, so let's start by taking the original cost as the original book value. And the salvage value is the final book value. Okay, so we're going to depreciate everything between those two numbers. Now, as I mentioned previously, the way we do that is we take the number 2 for double divided by the number of years that we plan to depreciate, which is 3. Right? Because they're planning to sell the asset in 3 years. So 2 divided by 3. We take that and we use that to calculate how much depreciation by multiplying it by our book value. So book value times 2 divided by 3. We take a $300,000 depreciation expense in year 1. Another way to think of that is we get to take 2/3 of that book value as our depreciation in the first year. So that is the only depreciation we've taken so far. So that is our accumulated depreciation so far. And if we subtract that 300,000 from our original book value, we get our new book value of 150,000. Then we take our new book value, multiply that by 2/3, which comes out to 100,000. We're going to add that in the accumulated depreciation column. So we've now taken $400,000 of depreciation, and we're going to subtract that $100,000 from the book value column. So we now have only a $50,000 book value for the asset. Then in the final year, when you're using the double declining method, you don't worry about the fraction anymore, the 2 divided by the number of years. Instead, you just depreciate whatever amount gets you from the old book value to the new book value, which in this case is $20,000. which means we have to increase our accumulated depreciation by $420,000, and we are now done with the problem, okay? So as you'll notice, the depreciation expense using this method declines every year. The book value declines every year, but the accumulated depreciation increases all the way up to the entire depreciable base, okay? Leaving only the salvage value that has not been depreciated. So that's how we do the double declining method. And Jane, if you have a question, let me know. I know that's a multi-step process, but if you don't have questions, I'll just go on to, I think next is number 11, no, number 10. So we're going to do 10, 11, and 12 together. Okay, 10's actually pretty easy. This is goodwill. This is a term in accounting that is used when you purchase a company and you pay more for the company than the net value of their assets. So in other words, if you took their assets minus their liabilities, that would be the net asset value, or it would also be the equity in the company. And if you paid more than that, the amount that you paid over that net asset value is goodwill. Okay, that amount never increases. So even if the company you purchased increases in value, you've never changed the goodwill amount in your account. It is possible, though, if you feel that the company that you bought has lost value, you can decrease the goodwill. So in this example, Buchanan Company buys McLaren Company for $5 million. And McLaren was really only worth 4.5 from an accounting perspective. So the net asset value was 4.5 million. So the goodwill is the difference between the two. So the answer to A, the amount of the goodwill, is $500,000. And that becomes evident in part B, where we do the journal entry. So again, the company paid $5 million for a $4.5 million company. I think the better way to journalize that would be here instead of net assets. I think that would make more sense. But anyways, maybe there's some reason they didn't do it that way. That doesn't really matter. What's important is we put $4.5 million as the net assets that we purchased. And the difference again is the goodwill, right? So our debits equal our credit. That's it for, oh, part C, I forgot. What journal entry should Buchanan write when the company internally generates additional goodwill? And again, the answer is you do not increase goodwill, right? So there is no journal entries since goodwill cannot be increased. It can only be decreased if we sold that company now to a different company. They could record a larger amount of goodwill on their books because of what they paid over and above the net asset value. But we would not increase the goodwill on our books. So that brings us to problem 11. Here we have a depreciation situation, and some of the variables are going to end up changing. So we'll see how it gets handled when some of the variables change. So the company bought a truck for for $15,000. That was the original cost. It had a salvage value of $3,000. Okay, let's make a note of that. And they expected it to be driven for 8 years. So first thing we need to do is figure out how much depreciation gets taken over the first 3 years. And you might be wondering why 3 years? Because then some things change and we'll have to revise our depreciation amount based on those changes. But in this situation, the first 3 years went as planned. So let's figure out how much depreciation would have been taken. Again, we start with the cost of the asset minus the salvage value. Then we divide that by the expected life of 8 years. Oops. And we get $1,500 per year as our depreciation expense. The question again was how much depreciation would they take in the first 3 years? So we would multiply by 3. And that means that they would be taking $4,500 of depreciation over those first 3 years. Okay, so it was cost minus the salvage value divided by the expected number of years, gave us our $1,500 depreciation amount, then times the 3 years, gave us $4,500. So that means we're starting year 4 with a book value of $10,500, right? The original cost minus the 3 years of depreciation. But now things change. They decide that they're only going to use the truck for another 3 years. Originally, they were planning to use it for 8, right? And only 3 have gone by. That would give them 5 more years. But they've changed their minds. So instead of 5 more years, they're only going to use it 3 more years. And they think the salvage value at that point will be $4,000. No problem. We had different amounts to calculate the depreciation in those previous years, but we don't need to go back and change anything. We're just going to now recalculate our depreciation amount and start that new amount from now. So we're going to start with our current book value, subtract our new salvage value, which gives us a new depreciable base. We're going to divide that by the 3 years we plan to keep using the asset. So $6,500 depreciable base divided by 3 more years of use. We get $2,167 if we round up to the closest dollar, which is what the textbook does for some reason. So that is going to be our new depreciation amount. So starting in year 4, our depreciation journal entry is going to look like this. Debit to depreciation expense, credit to accumulated depreciation of $2,167. Okay, so if you ever have to revise your depreciation expense, that's how you do it. You figure out what is your current book value as of that date, then subtract your new salvage value or whatever salvage value you happen to have, subtract that, divide by the new number of years you're expecting to use it, and you have your new depreciation expense. Okay, and we have one more problem to go, number 12. All right, we've got 3 different scenarios here. This company is selling some equipment that it owns. In all 3 scenarios, the equipment had an original cost of $76,800. So I'm going to go ahead and put that in all 3 places where it says equipment. So there we go. The equipment has depreciated $40,800 so far. So I'm going to copy that. I'm going to put that under accumulated depreciation in all 3 scenarios. Now, what's different in each scenario is in the first one, we sold the equipment for $47,000 cash. In the second one, we sold it for $36,000 cash. And in the third one, we sold it for $31,000. Okay. So obviously, there's going to be something different in each scenario. Well, in scenario A, we ended up making a gain. And how do we know that? Well, if the equipment originally cost $76,800 and it depreciated by $40,800, we can subtract that depreciation to get our book value, $36,000. Oh, what did I do? I put in the wrong amount, is what I did. Okay. Okay, sorry about that. So again, if we take our equipment cost, subtract the accumulated depreciation, we get the book value of the equipment. In scenario A, we sold the equipment for $47,000 and it only had a book value of $36,000. So that means we made a gain of $11,000, the difference between what we sold it for and the book value. So that gain we're going to put here over on the right. So we credit gain on the sale of equipment. If we were to check that, we could add up our debits. We get $87,800. And if we add up our credits over here, we also get $87,800. So we see that we must have done it right because our debits equal our credits. In scenario B, we sold it for $36,000, which remember was our book value, right? When we took our equipment minus the accumulated depreciation, the book value was $36,000. That's exactly what we sold it for. There is no gain and there is no loss in scenario B. In scenario C, we sold it for $31,000. Well, if our book value was $36,000, that means we have a $5,000 loss, right? We sold it for $5,000 less than the $36,000 book value. And now if we add up our debits, again, we see that they equal our credits, okay? So we can tell we've done that correctly. All right, so that's how we handle gains and losses, and that's part of why we need to depreciate. The depreciation gives us an expense that we can use to help reduce our tax burden, but we also need that depreciation information to know the book value on our assets so that if we sell them, we know if we made a gain, which will also be taxable, or if we had a loss, which will reduce our tax liability. All right, that is it for this chapter. We finished in just over an hour. Once again, Jane, are there any questions that you have?
No, not at this time.
Okay, all right, well, reach out to me if anything comes up. Otherwise, have a great week and I'll see you next week.
Bye.
Okay, bye-bye.